Okay, it is 4 o'clock sharp. We want to be respectful for everyone's time. My name is Dan Girard, managing partner of G9 Financial. I'm joined by managing partner Michael Crotty of G9 Financial, in addition to Pete Isburg from JP Morgan. Today's presentation is how to survive and thrive and investing in a pandemic. We thank you those who've taken time out of your day to join us here today and to participate in our event. Pete has, I've heard Pete's presentation numerous times over the years. Basically on a quarterly basis, he puts on this type of presentation to a group of advisors. However, if it was a year ago at this time, we'd typically be in a restaurant and not over a Zoom webinar. So Pete, thank you for doing this. For those who like a little fun fact about Pete, Pete is a runner. Pete, how many Boston marathons finished now?
3 Boston marathons and I think 11 or 12 marathons in total. So
that's about 11 more than me, and Mike for that matter combined. So with that, today's topic is investing in surviving and thriving in investing in a pandemic. As we go through the conversation, Pete, we appreciate what you do here, giving some insight, and we will add some color commentary as we go forward of how to be successful in what we feel throughout this uncertain times. So with that, please begin.
Awesome. Thanks, Dan. And thanks, folks, for taking the time to connect to today's Zoom meeting. What you should see on the screen are the words Guide to the Markets. And with that theme or thought around surviving and thriving, what we are going to do is share some material from the Guide to the Markets at JP Morgan. Just a quick thought on what the Guide to the Markets is for those that are perhaps a little less familiar. What it is a set of charts, graphs, and numbers that relate to markets, investing in the economy that at JP Morgan we are updating each and every day. So for the most part, all of the information that we'll share will be updated as real time as we can make it through yesterday's closing prices. In the same breath, I should probably share with you what it's not. Perhaps the unfortunate aspect of things, it's not the crystal ball, right? It's not necessarily our lens into the future, but thankfully when it comes to surviving and thriving investment-wise, it's not always about predicting the future, but typically an effort in the direction of seeing the present with some degree of clarity. And I would tell you that's our hope at the end of this evening's discussion, that you just have a clearer sense for exactly where we are. In terms of walking through where we are, I'd like to touch briefly on what's taken place so far this year from a markets and investments perspective. Regardless of what's going on with investments, it's always helpful to kind of step back and just think about the heart of the underlying fundamental backdrop. So we'll do that. Couple those two things, the investments have done this, the fundamentals say that, helps in developing any sort of investment thesis or view, but there are always some things that can get in the way. So we'll touch on a couple of those things, some of the risks or challenges that are out there. And certainly, although it's not the crystal ball, we will give you some sense of what we think about investing in stocks, investing in bonds, and investing in diversified portfolios. So moving right into it, I know I just said, hey, it's all charts, graphs, and numbers. And for the most part, it's going to be. But we do try to mix in a few pictures just to lighten up the discussion. And what you should see on the screen here is the picture of a roller coaster. This is not any roller coaster. This is a ride called King de Ka, which is at the Six Flags in Jackson, New Jersey. At the time it was built, it was both the tallest and the fastest roller coaster in the world. It is 456 feet tall and will reach speeds in the neighborhood of 128 miles an hour. So this would just be a guess on my part because I would never get on this thing. But depending on your screen size, you may or may not be able to quite make this out. But those little yellow blocks that sit up top, those are the roller coaster cars. That's where the people sit. And my thought is, as you're coming up the side of this really tall tower and getting in the range of 456 feet in the air, it's going to get pretty quiet in those cars. And as you bust down the side, touching speeds in the neighborhood of 128 miles an hour, there's going to be lots of screaming, lots of noise. And in that way, we'll often say that markets and investing can be roller coaster-esque. It's typically quiet on the way up with lots of screaming, lots of noise on the way down. And that puts us into, again, our first chart, graph, or set of numbers. This is just looking at the last 4 decades or 40 or so years on U.S. stocks, the S&P 500. if you look at those bars, there are numbers atop or below each of them in gray. And what they reflect is the actual price return for the US market or the S&P 500 each and every year for the last 40. So if we look at this second bar in from the right-hand side, you see a 29 atop the bar. That is the price return for the S&P 500 or the US stock market last year in 2019. Stocks were up 29%, and with the dividends, they were up a little bit more than that. When that's the case, there's not a lot of questions, and it tends to be pretty quiet. When we fast forward to this year's experience, it's been a little bit different, right? Stocks aren't necessarily up, they're down. Now, admittedly, there's been quite a bit of recovery. So the US market through yesterday without the dividends is down less than 1%. With them, it's basically flat. I think we all know at one point or another it was a lot more than that, which brings you to the other numbers that are on this page. Those red dots with the minus signs reflect the biggest sell-off within any of these calendar years. So if you bought at the absolute high and sold at the worst available low thereafter, how would you have done? This year's experience is reflected by that red dot with the minus 34. Between February 19th of this year and March 23rd of this year, the S&P 500 was down that amount. In 5 weeks, you're down 34%. So last year, up almost 30% in stocks, pretty quiet, not a lot of questions. When you get this as a backdrop, down 34% peak to trough in, call it 5 weeks, there's going to be lots of screaming, lots of noise, which can make it challenging to survive from an investment perspective. A couple of things we would point to say, hey, keep in mind in that regard in terms of the investment experience this year. This is a diversified mix of all different assets or investment exposures that you might hold in a portfolio. And I think that would be point number one, that when you're working with the folks at G Financial, not all of your money is in stocks, right? And it's certainly not all in US stocks. But again, if we were all in US stocks through yesterday, the US stock market is basically flat for the year. Now, stocks in the US are flat. You might have exposure to other stocks outside of the United States. If we look at emerging market countries like Brazil, Russia, India, and China, they're down a few percentage points. And Europe and Japan, reflected by the DM equity or the developed market equity, Europe and Japanese markets are down about 8%. So the US market has recovered quite a bit. International markets have recovered quite a bit, but overseas is down a little bit more than what we have here. But again, thankfully, when you're working with the folks at G9 Financial, depending upon your goals and objectives, you're going to have a different percentage of your portfolio in stocks alongside some exposure or a percentage of that portfolio in bonds. And although stocks can be down in other parts of the world right now, and the US market is closer to flat, bonds are actually up. And I think that's an important thing to keep in mind when you talk about not only surviving, but thriving when it's tough, knowing that the portfolio is a cross-pollination of a lot of these different options. And it's not just stocks, which were down, but bonds that were actually up in that difficult period. So just a quick run through in terms of the markets. Dan, Mike, anything you want to interject with there before we move into the next section?
I would, Pete, thanks for the opportunity. You know, one of the things, again, the theme of this conversation really is how to survive and thrive. One of the things that we hit on in our own personal client experience, and Mike, I think you'd agree, is, you know what, we put the work in up front to have a plan, an investment plan, a financial plan. As you can see, it is important to stick with the plan. If you called us back in April pushing, or not April, yeah, back in April saying pushing us to make some adjustments to go to safety, you may have locked in some losses along the way, and that's us some timing the market. Mike, any thoughts on that?
No, just to your point of the risk level, the plan is built around the goals that you have and the risk level that you have at the time, and we want to make sure we maintain that and the ups and the downs and not get too emotional about it.
Right. So survive and thrive is, in essence, stick to the plan. Stick to the plan.
Good points, Dan, Mike, and we'll certainly reemphasize some of that as we advance around the importance of sticking with the plan and staying disciplined in difficult times. Moving into this next piece, a young gentleman on the screen in that green jersey, perhaps less familiar to many of you that are on the other side of this Zoom discussion, but he's super familiar to me. That's my son, Thomas. He's 12 years old. It's a photo from the last vacation that we took. this fall down to Orlando, Florida, and we made a visit to the NBA experience, which I would tell you, if you have young kids or if you have grandchildren that like sports and like basketball, it's totally worth a visit when the time is right. This is one of their featured attractions, just a draft simulator. Allows you to go through that draft day experience. And this is my son standing next to a wax version of NBA Commissioner Adam Silver after being selected as the #1 pick in the NBA draft by his favorite team, the Boston Celtics. So look, when he's playing in town league and he's playing on travel teams, there's a real importance, and it's really stressed, the fundamental aspects of play. Can you take a decent shot, not just jack it up from half court? Can you pass to the open teammate or player? Can you go as well to perhaps your weak side, which for him is his left hand, as you do with your right? So taking decent shots, passing to open teammates, dribbling with both hands, important core fundamentals to being a decent basketball player. When you talk about investments in markets, there are a couple things that we see as critical or important to that fundamental backdrop, and they're economic growth and jobs numbers. And I just want to touch real quickly on a couple of those things. What this page shows you is the state of the universe for the U.S. economy. I want to zoom in on that white box up top just to give you a sense of the most recent experience in terms of economic growth. I know we said that all of these numbers are updated through yesterday, but when you look on the screen, what you're finding is data that is for the first 3 months of the year. That is in large part because you won't get an update for the second 3 months until the end of this month. But just to give you some context, two numbers in that box, they're very different numbers. The first one is plus 0.3%. What does that represent? It is the year-over-year change in the U.S. economy from March 31st of 2019 through March 31st of 2020. So what it tells you is we didn't grow a lot, but the size of the economy is actually a little bit larger at the end of March this year versus it was the end of March a year ago. Now, I think we all know it was more challenging than that in the shorter term. If we look just at those first 3 months, the U.S. economy didn't grow between January 1st and March 31st of this year. We actually saw a little bit in the way of economic contraction to the tune of around minus 5%. And it is very likely that when you get the numbers for the second 3 months, they can be more negative than that. So if you haven't heard this word, you're likely to hear it. The word is recession, right? Indicative of some sort of shrinkage or contraction in the U.S. economy. So just a couple of things to keep in mind if you're hearing that word and it causes any anxiety. The first would be when you look at the tall colored candy cane on the right-hand side, the biggest driver of the U.S. economy is actually us, U.S. consumers, going out there and spending money. And we would certainly highlight the fact that although there was some weakness in this economy and weakness in consumer spending, you have already started to see a turn in consumer behaviors. If you think about just some of the things we might consider spending money on occasion, you might throw down a few dollars to hop on an airplane and go somewhere nice and warm. When you get there, you might drop down your credit card to stay at a hotel or perhaps pay for an Airbnb. And whether you're traveling or you're local, a lot of us like to go out and have breakfast, lunch, or dinner at our favorite restaurants. I think we all know without seeing any numbers that those things were certainly more challenged in March and April of this year. What we would tell you is you have started to see a turn in some of the data related to those activities. It's a page from our book that looks at what we call high-frequency data. It's just a way to proxy what people are actually doing real time. As a measure of what's going on with the airlines, a good measure for that is the daily reading you get from TSA on foot traffic through security checkpoints, trying to get your arms around whether people are staying at hotels. There are hotel occupancy surveys that are released on a regular basis that give you a sense of that. And then sort of this purple row is seated diners from the open table reservation system, those that have actually reserved or checked in at a restaurant and actually sat down either inside or at a patio. So you're seeing two columns on the right-hand side. The minimum is the lows in April of this year. So if you look at that TSA foot traffic through security checkpoints, it was down 96% year over year in April. If you fast forward to where we are as of yesterday, still down a lot, but it's down 73%. Indicative of you've seen the worst in that, starting to bottom out and trending towards improvement. If you look at the hotel numbers, they were down, occupancy rates were down 70% year over year in April. Fast forward to where we sit today, still down, but down about half as much as that, down 30% year over year. And the restaurant business is the real extreme case. When we look at those seated diners as measured by open table, couldn't sit down at a restaurant in late March, early April, down 100% year over year. Fast forward to where we sit now, they're still down a bunch, but down 60-something% as opposed to that 100. So the real point is, although the numbers aren't particularly good, you started to see a turn off of those lows. And it's showing up in the real consumer spending numbers. If you looked at consumer spending for the month of May, which is 70% of the U.S. economy, month over month, consumer spending was up 8%. That move month over month is the biggest increase we've seen in consumer spending growth in the history of tracking the numbers. So it was a pretty big move. And I think above and beyond some of the trends that you're seeing there, don't overlook what the government has done and how it's impacting maybe the way we're feeling some of this economic challenge. They've put a lot of support behind the current situation. Just a few numbers for you in that way. Government has set aside $500 billion for distressed industries, including the airlines. I know small business owners are challenged. Maybe some of you on the line are small business owners. But are small business owners experiencing this in a moderately different way because of the $700 billion that was set aside in that Paycheck Protection Program? It doesn't help everybody, but it helped a lot of small business owners. You had $400 billion that was set aside to help healthcare and hospitals, and then the $150 billion that was put on the side to help states and localities. So none of those really big numbers erase this economic challenge, but they do help corporations and small business owners in some ways surviving through this difficult period and then getting through to the other side, which again, we do feel like you are going to get through to that other side. And just that second fundamental, talk about the turn in the economy, we would tell you you're definitely seeing some of that turn in the jobs numbers as well. Gray line on the screen here is the rate of unemployment in the United States. It's kind of buried underneath the light blue one, but what you would find, the unemployment rate in the United States in February of this year was down to 3.5%. That was the lowest level of unemployment we had seen in the U.S. in basically 50 years. When you shut down the entire economy in the second half of March and into April, you got a massive spike in that reading, right? The unemployment rate went from its lowest level in 50 years up to 14.7% because of this economic shutdown here in the United States related to the virus. Lowest level in 50 years, highest level in 8 decades. You have started to see, although it's hard to make it out, that line actually go back lower. Just 2 months later, you have an unemployment rate that's still elevated from where it was, but through the end of June, now you're at 11%. So starting to reverse in the other way. Did we add jobs in the U.S. economy in the month of June? We did. The number was 4.8 million. That's the biggest monthly print you've ever seen. Did we add jobs in the month of May? Yes, 2.7 million. Tally those figures together, 7.5 million jobs in just the last 2 months. Now, I'm calling them new, or I'm saying they're added. In some ways, that might be a tick unfair, right? Because in the month of April, you gave away jobs. But you are actually seeing these people come back to work as you've gotten a bit of reopening in different parts of the country. So the numbers that relate to the economy and jobs can be a little disconcerting, but you're starting to see a reversal in the trend. And just the last thing on this jobs piece, and I think this is super important as well. Government has helped or provided assistance for corporations and small business owners. Wouldn't want to overlook what they have done in support of individuals and households. Few figures in that way. $290 billion that was set aside in the form of those direct payments to the households that need it most. So $1,200 per adult, $500 per child. Another $260 billion that was set aside to enhance, expand, and extend unemployment benefits. What does all that mean? It means if you're collecting unemployment right now, the size of that weekly check is $600 greater than it would normally be in traditional times. Historically, if you were self-employed, you couldn't collect unemployment. Now you can actually file and get benefits if you are self-employed. And the last piece of this, if you are collecting, typically you would collect for 26 weeks. Now you're eligible to keep getting those benefits for up to 39 weeks. So none of those numbers make the high unemployment rate disappear, but you're certainly seeing folks experience that in a moderately different way. If the income level for a household as a single filer were below $55,000, that person is actually better off today than if they had their job. So I think the broader point would be that the economy and jobs going through a period of challenge, but you're starting to see a turn in the numbers, and the support from the government makes the experience a little bit different than what it might normally be. Mike and Dan, anything you want to toss in there on that front, or just more broadly before we move into the next piece?
No, I would say in our own personal practice, we have seen folks, again, come and go from the working environment, being laid off and being put back to work. So from that perspective, we see a turn. Where it goes, who knows, with what's going on out there in the current state of COVID-19.
Yep.
Yeah, and I think the other thing to add to it would be is we had a talking point about if your plan changes because of unemployment, change in job, that's or just your change your plan, you're going to do a house project or whatever it could be, that's when you want to come back to us. So again, surviving and thriving through this. If something comes up, we're here to help and to talk to you about it.
Right. The one thing I will add is we've had several clients through this pandemic who have been, through a loss of job, have eased their way into retirement. This has been, for some, an early retirement package to a degree. An unplanned package, right? So again, if that is affecting you, it's a planning opportunity to come back and for us to have a conversation to fine tune that plan.